So the Kenya Bankers Association says that its customers can now expect more transparency and clear disclosure in the new credit pricing model. The move follows the Central Bank of Kenya's directive aimed at finalizing the transition to a new risk-based credit pricing framework, a move that is expected to significantly alter how banks price loans and interact with borrowers. This would mark a shift from the long-standing central bank rate to a market-driven interbank rate as the primary benchmark for loan pricing. Jimmy Mbogo explains.
In the central bank's proposal of April 2025 on risk-based pricing, the regulator sought to have commercial banks use the central bank rate CBR as the common reference rate for determining the lending rates in the banking sector, with the use of premium K, which would consider the bank's operating costs related to lending, return to shareholders, and the borrower's risk premium. A proposal that the umbrella body for banks, Kenya Bankers Association, pushed back on, noting that it was equivalent to an indirect interest rate cap. CBK then yielded ground, saying that, and I quote, that the respondents proposed the use of interbank rate to align with the global best practice, where the base rates are derived from short-term market rates. According to the bankers' umbrella body KBA, this, and I quote, will enhance transmission of monetary policy and transparency to customers on how lending rates are determined by banks. KBA further argues that the use of benchmark rate and the inclusion of the premium K, which largely reflects the cost of funds and the customer's own risk profile, will enable customers to understand their risk profile and deliberately seek for ways to improve it, noting that, and I quote, this ultimately reduces interest rate on loans they receive from banks. All factors driving lending rates will also be disclosed to customers on the total cost of credit that KBA co-hosts with the CBK. Crucially, according to the Kenya Bankers Association CEO Raymond Molenje, the model also promises to expand credit access to groups that have been historically excluded from mainstream lending, noting that by facilitating flexibility in pricing, banks can effectively serve all risk categories in their models, thereby affording to extend credit to all while ensuring that their price mirrors their respective risk profile. The adjustment in risk-based pricing model is expected to provide a lasting solution in unlocking credit to the private sector. Jimmy Mbogo, Citizen TV, Nairobi.